Welcome. We're going to demystify some of the most important concepts in startup finance: valuation, dilution, and the terms investors look at when they invest. We'll break it down step by step so you can understand how investors think and what it means for you as an entrepreneur. Valuation basics. First, what do we mean by valuation? Simply put, it's the process of determining the value of a company or asset. There are many ways to calculate it. Some are objective, based on numbers. Others are more subjective, based on assumptions and market expectations. The simplest formula you may see is value equals number of shares times price per share. For example, if a company has 1 million shares at $12.50 per share, the value of the company is $500,000. Next, we have pre-money and post-money valuation. These are key terms in investment. Pre-money valuation refers to the company's value before an investment. Post-money valuation is the value after the investment, which is the pre-money valuation plus the new investment. So if your company is valued at $750K pre-money and an investor adds $250K, the post-money valuation is $1 million. In this example, founders might hold around 75% and investors around 25%. Valuation methods. Valuation isn't one size fits all. Different companies and stages require different approaches. For later stage companies, you might use discounted cash flow based on projected cash flows, asset accumulation, subtracting liabilities from assets, market comparables or similar transactions. For early stage startups, methods include the venture capital method, which looks at expected ROI, the other methods, which assess 5 key success factors for seed stage startups, such as sound idea, prototype, etc. Each factor has a maximum fiat value, such as dollars or pounds, adding up to a pre-money valuation. Pre-revenue startups usually have lower ceilings. Point. The subjective side of valuation. Why is valuation so hard? It's partly numbers, partly judgment. Startups may not have clear income or cash flows. Growth assumptions vary widely. Market conditions and geography can shift the expected value. So, valuation is always a mix of science and art, price per share and dilution. Let's talk about dilution. Simply put, dilution happens when new shares are issued. This reduces the ownership percentage of existing shareholders. For example, in a Series A round, investors typically take 20 to 25% of the company. If you aim to raise $2 million, you need to consider what pre-money valuation keeps dilution reasonable. Remember, dilution isn't bad. It's a trade-off for bringing in capital and expertise, growth. The cap table, the capitalization table, or cap table, shows who owns what in the company. Other items include number of shares per founder, employee, or investor percentage ownership, option pool reserved for employees. The initial cap table depends on contributions from founders, early employees, and advisors. It shows equity distribution before any investment. Term sheets. A term sheet is a non-binding agreement outlining the terms of an investment. It typically covers 2 main areas: economic terms, like pre-money valuation, and investment size control terms, like board representation and voting rights. Other important items include option pools for employees, liquidation preferences, anti-dilution protections, rights like preemption and drag-along. Liquidation preferences. Liquidation preferences determine how proceeds are distributed if the company is sold. Anti-dilution protection. Anti-dilution protects investors if a future round is priced lower than the previous round. 2 main types. Full ratchet converts shares to the new lower price, weighted average, slightly more balanced considering the number of new shares and old shares. These terms can feel complex, but they're all about balancing risk between founders and investors. Convertible notes. Finally, some startups raise money through convertible notes. These are short-term loans that convert into equity later. Key features include conversion discount, often 20% valuation cap, limiting the conversion price interest, usually a few percent per year. Convertible notes are quick, simple, and avoid negotiating full valuation up front. Exercises. Practice these: calculating pre- and post-money valuation, assessing dilution and option pools, interpreting liquidation preferences and term sheet terms. The goal is to understand the mechanics, not memorize formulas. This will help you negotiate confidently and make informed decisions. If this is too daunting or you'd like to know more, subscribe to the channel and leave a comment so I can direct you to the correct place. Be sure to check the description for resources.